Hi, this is Dr. John Bergduff, and in this video we're going to talk a little bit about how income tax is calculated. Now before I get too far, I want to make sure that you know what this video is not. So this is not intended to be advice on how to do your income tax or even information on how to fill out the forms or how to use an online system to file your taxes. So if you were searching around on YouTube hoping to find videos with advice on income tax or how to fill out your forms, unfortunately you've come to the wrong place. I am not a tax accountant. I'm a humble math professor in Texas, and the purpose of this video is for educational purposes to talk about how the calculations are done when you figure out your income tax, looking at some very basic situations, but particularly talking about how the tax brackets work. So in this video, we're going to explore some of the major ideas that go behind the calculation of taxes. We're going to talk about gross income. Your gross income consists of your wages, tips, interest, dividends, and profits. Now, for the most typical person in the United States, most of our salaries are most of our income is based on wages and maybe tips. Certainly some people who make a lot of money, money also comes from other places, but we're looking at a simple example primarily. Now, there's a number of words that we're going to explore that sound like they mean similar things, and in a way they do, because they are all quantities that you can subtract from your gross income before you calculate your taxes. So, for example, we're going to talk about adjustments. Adjustments are numbers that you get to subtract from your gross income before you calculate your taxes. And some of the primary examples for a sort of regular working class, middle class folks are contributions to retirement annuities and interest on student loans. There are others, but those are some pretty nice examples. So when you figure out your tax, you actually don't base it on your gross income. You base your taxes on your adjusted gross income, which consists of your gross income minus your adjustments. And I've got a specific example planned in a little bit where I'm going to show you exactly how this works. Now here's an idea that sounds like it might mean almost the same thing. Exemptions. And in a way it's similar because it's a quantity that can be subtracted from your gross income before you calculate your taxes. What exemptions are, or maybe more specifically what exemptions were a fixed amount that you can deduct from your adjusted gross income based on yourself and every additional family member living in your household. So it was a specific number, and you get one exemption for yourself. If, let's say, you're married, you get another exemption for your spouse, and suppose you have 3 children, you get an exemption for each of them too. So for a married couple with 3 kids, they would have a total of 5 exemptions. And that exemption is a dollar amount for each one of those 5 people that you subtract from your adjusted gross income. Now, interestingly enough, exemptions no longer exist. There was a revision of the tax code in 2016 in which, among other things, the exemptions were eliminated. This was the middle income tax reform introduced in the early days of the Trump administration. But it does mean exemptions are no longer there. So why am I even mentioning this? Well, in the textbook that we use at the college where I teach, which is Lone Star College in Houston, the book was written in 2016. And so all the examples in the book are based on how income tax looked back then. This is a pretty significant change, but in a way it's not bad because I can show you both how income tax looked before and after this reform was done in in the early days of the Trump administration. So we'll just remember that that no longer exists. Now there's another number that you get to subtract from your adjusted gross income. We've already had adjustments and, well, we don't really have exemptions anymore, but that's a word that people use. We also have deductions. Now for deductions, you get a choice. You can take a standard deduction, which is a specific amount, depending on if you're filing as a single person, as a married couple filing jointly, as a head of household. That varies from in those different categories. You can take a standard deduction, or if you prefer, you can itemize your deductions, where you can go through a list and keep track of specific quantities that you have spent. And it may be that the itemized deductions will be more advantageous, or it may be that the standard ones would be. So examples of things that you can deduct as itemized deductions are interest on home mortgage loans. And obviously you've got to actually own a house to be able to do that. Property taxes, again, that only makes sense if you own property. Sales taxes, that's state and local taxes. Charitable contributions. And some medical expenses. They have to be above a certain percentage of your adjusted gross income. So if you have a lot of medical expenses, it's possible you may be able to deduct those as well. You get to choose whichever of these works best for you, and then from that you calculate your taxable income, which is your adjusted gross income that we talked about on the previous page. Subtract off the exemptions, back when we had exemptions, and subtract off deductions. You figure your taxes based on that taxable income. And I'm going to talk about what that looks like in a minute. Now, even after you calculate your taxes based on your taxable income, that still may not be exactly what you pay. There are also things called tax credits. And tax credits are an amount that you get to subtract dollar for dollar after you've calculated your tax computation. You can then take away. Not a whole lot of these are available to just sort of the average working class or middle class person. But an example that's currently available, for example, is that you can take a tax credit for putting solar panels on your house. Again, if you don't own a house, then that doesn't really help. So let's take a look at how the calculations are made once you know your taxable income. Now, here's where I'm going to show you both 2016, when the book at our college was written, and also what is going to be true for 2021, the current year that we're doing taxes for. In 2016, the exemption per person was $4,050 per person. Again, you take that for yourself and for each member of your family. So if you're a married couple with 3 kids and you're filing jointly, you would subtract 5 times $4,050 from your taxable income. Also, the standard deductions vary from year to year. In 2016, the standard deduction was $6,300 for a single person or a married person filing separately, $12,600 for a married couple filing jointly. Now, you've heard about tax brackets. You pay different taxes based on where your income falls. So let's say you're a fairly wealthy person and your taxable income is, let's say, $200,000. $200,000 would put, you're a single person, let's just say that. $200,000 would put you here in this bracket. And that at first leads you to think, oh, okay, you're going to pay 33% of your $200,000. But that's not really how it works. These form bands, and what happens is you pay 10% on the amount up to $9,275. You pay 15% on the amount between $9,275 and $3,765. you pay 25% for the amount of money in this band, 28% for the money in this band, and only 33% for the amount of money that goes over $190,151. And I'll show you a calculation on that in a minute. Just so we can compare, this is the tax information for 2021. I want you to notice, first of all, that I mentioned right here that the exemptions are no longer available. The standard deductions, however, are a good deal higher. $12,550 for single person or married person filing separately, $25,100 for a married couple filing jointly. Let's back up and compare. That's versus $6,300 and $12,600. So the loss of the exemptions is made up, at least to a partial degree, by having these deductions, these standard deductions being a little higher. Notice that the tax rates are a little bit flatter. We have 10, 12, 22, 24, and so forth, instead of 10, 15, 25, and so forth. The highest tax rate in 2016 was 39.6%. It was reduced to 37% in 2021. Okay, that's all real nice as far as sort of general information. Let's look at a specific. So I have made up a person that I'm going to describe for you, and we're going to calculate his taxes based on the 2016 rules and the 2021 rules, just so we can see the contrast. This fellow is a single man. He has no dependent children, and he owns his own home. That's going to be important because it affects what he can deduct. Here's his gross income. Now he has some student loans and he's paying some interest on those, and this is his annual interest on his student loans. He is making contributions to an IRA, an individual retirement account. He is setting aside money for his retirement into an IRA, and that money that he set aside for this year is $3,800. Now, he does own his home, so he has property taxes to pay, $2,200. He has a mortgage on his home, and the interest that he's paid on the mortgage is $2,500. He's made some charitable contributions to his church and some other things that he's interested in, and those total up to $2,400. He's also had some health issues this year, and he has $1,500 in deductible medical expenses. Now that would be $1,500 above that minimum percentage I was talking about. So, he's got some pretty high expenses. In addition, he decided to put solar panels on his house this year, and there's a tax credit for doing that. So we're going to see how that comes in as well. So what we are going to do is we're going to calculate this fellow's income tax using both the 2016 and the 2021 rules, and we'll see how it works. So let's start with 2016. So his gross income, not grossest income, but gross income is $62,000. Some of the items on that list that I gave you classify as adjustments, in particular interest on student loans and contributions to an IRA. Those would add up in his case to $4,000, and those are adjustments that he is going to get to take off of his gross income right away to create this thing called the adjusted gross income. The adjusted gross income, you take your gross income of, in his case, $62,000, subtract off these adjustments, and therefore his adjusted gross income is $58,000. That's still not what he pays taxes on, because we're going to subtract off some more things. We're going to talk about his exemptions. Now, under 2016 rules, he could claim an exemption for himself. One exemption, no spouse, no children, so he can only claim the one exemption. And that exemption going back was in the amount, going back to 2016, of $6,300. Oops, no, that's his deduction. Sorry, that's not the right one. The exemption was $4,050. He can claim that. Sorry about that. So he has one exemption of $4,050 that he can deduct before he figures his taxes. So that's good to know. Now he needs to think about his deductions. And here he has a choice. He has to decide what's better for him: to take the standard deduction, which was $6,300 back in 2016, or to itemize. Now he has quite a few deductions, so it might be worthwhile to add up those things that are deductible: his property taxes, his mortgage interest, his charitable contributions, and his deductible medical expenses. He can add up all of those, and if he does so, he'll get a total of $8,600. In his case, it would be more advantageous to use itemized deductions instead of the standard deduction, which is lower. So based on the adjusted gross income and the exemptions and deductions, we can figure out this fellow's taxable income. That's going to be his adjusted gross income. Let's look back at what that was. The adjusted gross income was $58,000. So we'll take the $58,000 minus his exemption. He does get to take that one exemption for $4,050. Minus his deductions, and he is going to itemize. That'll be more advantageous for him. So he will subtract off the $8,600 in itemized deductions. That will give him his taxable income. And that taxable income turns out to be $45,350. This is what we will calculate his taxes based on. Okay, let's see how that works. So here's his taxable income again, $45,350. And I've only put a portion of this tax rate chart in here because it's going to be far enough to see what his taxes are. $45,350 would put him in this band. Again, he's in the single category, not the married category. But that doesn't mean he pays 25% on the total amount. What he pays is 10% on the first $9,275. Pays 10% on that. The way you would do that calculation is you would take 0.10 and multiply it by $9,275. That would give you, remembering to put the dollar sign in, $927.50 on that band of income. Now, he pays $15,000 on the next amount up to $37,650, but let's be careful about that. He's not going to pay 15% on that amount. He's already paid his income tax, or figured his income tax, on the first $9,275. So that's gone. He will only pay the 15% on the next money up to $37,650. So that's $37,650 minus the $9,275 that he's already calculated his taxes on. So $37,650 minus $9,275 is, and we're going to take 15% of this, 15% times, and that amount is $28,375, giving me taxes on that bracket of $4,256.25. So that takes care of the first two brackets. Now his taxable income is in the third bracket, but he's already calculated his taxes based on the first $3,650. Actually, I should circle that one. So we're only going to be looking at the amount above that, and he will pay 25%. So notice how much that rate jumps on the amount above $37,650. So that would be based on $45,350, his taxable income, minus the $37,650 he's already done his taxes on. And so what you would do is you take 0.25 for 25%, times that difference. The difference turns out to be $7,700. And that gives him, for that band, taxes of $1,925. So how does that all come together? Well, he's paying this amount of tax on his lowest bracket of income, this amount of tax on the middle bracket of his income, and this amount of tax on the highest bracket of his income. And what you simply do is you add all that up for a total tax computation, and adding up those numbers would give you $7,108.75. $71,000 would be pretty tough. $7,108.75. Now that doesn't necessarily mean that that's his taxes, because what we will do is we have to remember that he also has a tax credit that he can take off. So he can take the $7,108.75 and take off that tax credit, and what he actually will pay in taxes is $6,608.75. So I hope that makes sense. Now, in real life, you don't have to go through these calculations like we do here. If you're using a tax preparation software, you just enter in your taxable income and it does all this for you. Or even if you do it with pencil and paper, the tax table at the back of the form that you get, of the booklet you get, well, you just enter in your taxable income, you look for it in the chart, and it just says, here's your tax. So you don't actually have to calculate it, but it's really interesting to know how that's done. Let's see what would be different in 2021. We're going to do this over again under the new rules. So some things don't change. The gross income is still the gross income like before. Adjustments haven't changed. That's just in his case, his student loans and his contributions to an IRA. That's $4,000. That's just the way it was before. And so his adjusted gross income doesn't change either. Calculated the same way. Nothing's changed there. The $62,000 minus the $4,000 in adjustments, and that gives him $58,000 in adjusted gross income. What's different in the new system is there are no exemptions. So $0 for exemptions. That's gone. Now, what is different, though, is that the standard deduction is higher than it used to be. So it may be the case that his decision about itemizing or not might turn out different. He can still itemize his taxes, and he should. He should figure out what that would be, just so he knows whether that would be a good idea or not. These are the same deductions you had before, and you just add those up like you did before, and that gives you $8,600. Which was a better deal under 2016 rules, but under 2021 rules, the standard deduction is much higher, and so he's better off with that. So what he will do to get his taxable income is he'll take his adjusted gross income of $58,000. He'll subtract off his exemptions, of which he doesn't have any. That's zero. That's like a trick question. And he'll subtract off his deductions, $8,600. Excuse me. No, he's going to use the standard deduction. Sorry about that. I just made that big, long speech. He's going to take the standard deduction of $12,550, and that is going to give him a taxable income of $45,450. Let's figure out his taxes on that. Here's his taxable income. That still puts him in this third band, but this time the tax rates are lower for each band, so that should help him out. Let's see what happens. So this is going to be very similar to before. You're going to take 10% of the first, in this case, $9,950, and that will be $995. You'll take 12% of the amount in the second band, so that's the amount between $40,525 and the $9,950 you've already looked at. That's 0.12 times, and then that difference turns out to be $30,575 for a tax on that bracket of $3,669. You can check these numbers for yourself. He'll pay 22%, and again, notice that gets to be kind of a bigger jump there, on whatever is his taxable income above $40,525. That would be the $45,450, which is his total taxable income, minus the $40,525 that he's already done his taxes on. 22% is 0.22, and that difference between the two amounts is $4,925, and that would give him taxes on that band or bracket of $1,083.50. His tax computation will be the sum of these amounts. Add this amount on the first bracket, this amount on the second bracket, this amount for the third bracket. Add those up, and if you do that, you'll get a total of $5,747.50. And I hope that makes sense. But again, that's not going to be what he actually pays. He still has a tax credit. That still holds. So you take the tax computation that you get, or that in real life you would either look up in the table or have your tax preparation software do for you, subtract off the $500, and that gives him a total income tax under the 2021 rules of $5,247.50. That's under the 2021 rules, and just by way of reminder, under the old rules, he would have paid a little bit more. And the truth of the matter is, the adjustment in the tax system, under that adjustment in 2016, is beneficial for some people and hurtful for others. It just depends on your circumstances. You can probably guess that with the exemptions gone, anyone who has more dependents is likely going to have a little bit more difficulty because they're not able to take all those exemptions, and the standard deduction stays the same no matter how big your family is. So that's kind of a deal there. So I hope that helps. A nice overview of how taxes are calculated, and I wish you all the best.